our audience always well aware of the standard disclaimers, but in the want of time, sir, we can start with the disclaimers, and then maybe, although somewhat we touched upon this yesterday, but I would request you to come again on maybe broadly your thoughts on the earnings which have released so far as on date. Yeah. Broadly sector wise, I mean, apart from healthcare and pharma, also you always track consumption space and other spaces.
Sure, sure. Yeah, so the standard disclaimer, I mean, we do this all
And
the time. None of this is kind of, any, not even remotely any sort of recommendation. It's just trying to discuss and answer your queries and help you out in your thought process. That's the whole objective of this session. So thinking about this sector, I think the best space that I liked in the numbers was the consumption, both FMCG and non-FMCG, because clearly there is pain. And wherever there is pain, there is an opportunity. So that's one sector, um, consumption in general, and the tax cuts in the budget, they will start reflecting probably from Q1. Uh, but I think the worst of the selling may be over because markets generally are forward looking. Even the short term fund managers, they tend to be patient if they know that there is earnings recovery around the corner, and the forward rate of change is finally getting positive, which I believe should be the case with majority of the consumption. And again, it's company by company. So I've I've been through many earnings calls, both live and reading through the transcripts or listening to the audio recording thereafter. It's so it's so diverse, because every company is selling a different product, right? And so food consumption is different versus non-food consumption. So food consumption as in QSR or food retailing as an example. And discretionary consumption is something that I particularly like because for the simple reason that you may delay the demand, but you cannot deny. So if there is a home improvement project that you need to undertake at some point, and maybe if you are tight on cash, you may delay that by another year or so, but it's unlikely to be denied ultimately. Whereas if you are hungry and if you feel impulsive and if you did not order that pizza this evening, you'll unlikely be ordering the same pizza tomorrow. So the impulsive buying is a different kettle of fish. I'm talking about the consumption, which is very thoughtful, non-impulsive, and that you know may become maybe coming back and maybe coming back with a vengeance. It may not all be panning out in FY26 because people may not be just buying everything in the one go. Because when you get surplus cash, you may be buying a two-wheeler, or you may be doing a home improvement project versus you may be doing something else. So depending upon where is your pecking order or the priority order, you will start your consumption in accordingly. But I think clearly there are green shoots, or there will be green shoots, if not in fourth quarter, then the first quarter. So that's one pocket where I like, and my template is very simple. I tend to hunt in places where the management quality is good, um, and even if the management quality is fair, and there's a slight catch here. So it doesn't have to be a TCE management or a triple A rated management all the time. So DVs as an example, if DVs is a TCE management, but why will I pay 18x sales? I won't. If there is a fair management at 2 times, 3 times, 4 times price to sales, I may be much more comfortable. So valuation is also important, especially if you're buying for 1 year or 2 year, then I think the valuation is equally important, if not more, relative to the management. If you're buying something as an SIP staggered and you don't care whether the stock falls 20%, 30%, then your management should be your first criteria. So coming back to consumption, majority of the management in these pockets are good. Majority of them. Of course, there will be exceptions. So when the business cycle is at the bottom and the forward rate of change or improvement is expected to turn positive in the near term, it's highly unlikely, probabilistically speaking, it's highly unlikely that the stock will correct from here on. So your downside is pretty much capped, pretty much. And within 1 or 2 years, you will find that there are many stocks that will, and I'm talking about consumption, so you don't get 10x in 2 years, but many stocks can easily double in 2 years, not even three. So fiscal 26 and fiscal 27, because the expectations are low, the earnings are low, and when you get low expectations and low earnings, and when you invert the two together, so earnings becoming positive, better, YOY, and the expectations going from pessimism to realism and ultimately optimism, you get a very large delta. So consumption is one space where I enjoyed the numbers. The numbers were not positive, and probably that's the reason I enjoyed tracking those numbers. Other than that, I see there's a cement is another example. So the whole industry, the whole building materials ecosystem is struggling. But that means the value will be probably in those pockets. Entire building materials space, right from cement to tiles, all of it. That's the pockets to hunt, and it's very easy to figure out, which is a good management. I'll give you very simple anecdotal or statistical data rather than anecdotal. A management that has delivered in the past cycle will likely deliver again, because problem is not internal, problem is external environment. Point number one. Number two, screener will tell you whether the cash flows, the operating cash flows have grown significantly over the last decade, and look at the gross block. If the operating cash flows have improved dramatically and the gross block has improved dramatically over the last 10 years, in the balance sheet, there is hardly any stress. The balance sheet is still having net cash. So in a down cycle, if the balance sheet is net cash and the management has delivered in the past cycle, you are time is your friend. So those are the pockets that I would definitely be very keen to observe. And then consumption has a derivative or a n minus one, right? And n minus one of consumption is chemicals. And by and large, chemicals have struggled since the boom of 2022, which was unrealistic and irrational to begin with. Now this pace is settling, and I see a lot of positivity in terms of the valuation. And I would like to buy um, value ahead of the growth. That's how you make large alpha. When you buy value ahead of the growth. People made large alpha in Newland Labs because they bought value ahead of the growth. People will not make a 10 bagger in divis. People will not make a 10 bagger in divis even if they wait for 10 years. Because the starting valuations are 17x, 18x, 19x. And some of the chemical IPOs, they came at those valuations in 2021. We know what happened. We know what happened with Gland Pharma from the IPO valuations. We know what happened with Supriya Life. So many examples. So there, I go for, or at least I aim for minimum 10x in 10 years. And the and if your objective or the goal is minimum 10x in 10 years, then large caps are pretty much out. You cannot. By definition, you cannot. The other space that will be out is where the valuations are already rosy and rich, and there is a kind of a carnival atmosphere on social media. So, if you declare you have bought a company XYZ, there are no questions being asked, and you're getting thumbs up and likes left, right, and center. That's a clear red flag. You have to invert. And putting a stock name on the Twitter is a great idea, because the more the people are negative, they will give you the data points to screen. So if I used to post Newland Labs in 2019, 20, 21, and people used to give me, 5, 6 reasons where I should be uh, extra careful about it. There will be red flags all over. So it helps your research actually. It's kind of open source software. You go out in public, you stick your neck out. Yeah, of course you will get, one or two trolls here and there, but that's fine. It kind of serves your purpose. It's a very high ROCE investment. You throw a stock in the public domain and you see what the chatter is. Is it all positive? If it's all positive, that's a risk. If it's all negative or majority of it is negative, perhaps there is an opportunity to screen the annual report and sift through the earnings and transcripts if there is one. So so that's, I know I digressed a bit, and then coming back to the results that I enjoyed again, chemicals and pharma will always be hit and miss. So some results were positive, um, and some were not that positive, and where the results have not been positive. My next question is how soon the tide is likely to turn. So I'll give you one example. Again, no recommendation. Indoco Remedies. I went on to their call, and I know that the business is at the bottom. Business cycle wise, business is at the bottom. But I got the impression that the tide is not turning anytime soon. And the reason I got the impression that the tide is not turning anytime soon is because there is an external dependency on US FDA. So it's good business to track because it is hitting what I call rule 2, which is bottom of the business cycle, but perhaps is not a good idea to um, add or even buy fresh because the rule 1, which is the positive forward rate of change, is not imminent. It's not clear. Whereas I went on Copran's earnings call and I asked them several questions. And my second question was the bankruptcy scenario. So I started discussing, what can permanently kill business like Copran. And I updated on my anti-fragile, updated to my anti-fragile investors on Substack that looks like the worst is over. And for these reasons, when you get the transcripts, I would encourage everyone to read through. That's what my update was on the anti-fragile channel. So when you join a earnings call, if you're reading a transcript, you should be very selfish in terms of, what is the probability of losing money from this point? Because not losing is equal to winning. And I think most young investors, most, not all, new investors, they think in a completely opposite manner. They go with the intention of making a 10 bagger and that too in a jiffy. I think that's the wrong approach. Your first question should be, um, again, you got to be self-aware, but you should be thinking in terms of, the margin of safety. Because even if you buy a stock, the stock doesn't feel your expectations or emotions, right? And a highly valued business, a random event will not care whether you are long or short. So 2021 diagnostic IPOs, 2021 chemical IPOs, any sector, and I'll give you a much more general rule. Any sector where you are experiencing a slew of IPOs. So there is a weekly IPO coming in that sector, or a monthly IPO coming in that sector, or two or three IPOs have come in this specific sector in a month. It's a clear red flag because investment bankers are sensing an opportunity. An informed buyer is selling to a naive, informed seller is selling to a naive buyer. That is so those are the, otherwise the healthcare as a space, if anyone is in their 20s today, I think healthcare as a space, if you could curate a healthcare index, I don't know if how easy or difficult it would be. That index should run faster than the Nifty as a whole. Because I expect over the next 10, 15 years, Nifty will gain disproportionate share of healthcare. Currently, healthcare is underweight in Nifty. Over the next 10 years or 15 years, healthcare will incrementally gain because Nifty or Sensex or any index globally is always rigged. Good stocks will enter and bad ones will exit. So the compounding is always faster in an index versus, your own direct investing. The reason people don't subscribe to index investing is because they think they can outsmart everyone else. And every fund manager will think like that. मेरा वाला stock ज़्यादा अच्छा है. It's the game theory. It's the classic prisoner's dilemma. So be sensible and actively hunt for companies and results where there is disappointment or there have been a protracted period of disappointment and where evaluations are much more reasonable, where there are clear visible signs of um, uh, earnings power emerging. And earnings power is usually in things like depreciation. If the depreciation has doubled in the last 2, 3 years, that's earnings power. If the gross block has significantly gone up in last 2, 3, 4 years, that's earnings power. Because both of these factors put together, they are related anyway. It will dilute your current or near-term earnings. And no, there will not be a Twitter or a social media fancy or validation. But that's where the alpha is expected. So chemicals is one pocket, by and large, and consumers. Those are the two sectors that I would, and consumption, as I say, it could be two-wheeler consumption, it could be cement consumption, it could be building materials, it could be a QSR. And consumption is also healthcare related consumption across the ecosystem from insurance to TPA to distribution and so on and so forth. So these are 4 or 5 pockets because it's in my circle of competence, so to speak. I get a better handle if something is completely new sector. So defense as an example, where there are a lot of government interaction. That may not be, I may not be knowing everything. Whereas in these pockets, at least I know what I don't know. So I can meaningfully or realistically calculate the intrinsic value, that what is the estimated value of this business, and if I'm getting a significant discount and against that estimated value, then I'll be very interested. That's how I would put it.
Right, sir. So to start with, the one question is repetitively coming, and you also asked me to remind on Deepak Nitrite. So, sir, do you believe the result, although you highlighted, is in line the retail saying retail won't be wise, but again, impatient investor always see things from price movement point of view. But again, we are asking in sync with the business
Sure. No,
development.
so depending upon, so let me, self-awareness again is very important. What kind of investor you are? If if you are looking for a large alpha in next 3 months, Deepak Nitrite probably is not this stock for you, because I don't expect Q4 to be a full-blown recovery wala quarter. Versus if you are a 5-year investor or a 3-year investor, then Deepak Nitrite was definitely good starting today. And clear disclaimer that I own this stock, um, but I have been invested in Deepak Nitrite since 2016, and I've added along the way. But majority of my buying was between 2016 and 19. Majority of my quantity-wise buying is in that era, and that buying that is giving me a large alpha today. So you have to be patient. Results were below expectations. There is absolutely no doubt about it, and hence the market reaction, because there is lot of momentum, short-term money in markets. No one has got the time to wait. And that's exactly where the SIP investor will thrive. Because if there is depression or gloom, you're getting a better asset in the sense that the business has been investing. Deepak Nitrite definitely has been investing. Deepak Nitrite of 2016 is very different compared to Deepak Nitrite of today, and there is no reason for me to not believe that the Deepak Nitrite of 2030 will not be a better and a bigger business. So, so you can be much more patient. And I shared the formula for SIP. It's a proven formula. You can try it on a one stock. So I gave you the portfolio level perspective. Exactly the same formula. You try and apply it on a single stock. If there is all things being equal, so the management hygiene checks are taken care of. That's fundamental. So you can never do an SIP in Syntex Industries kind of a business or a Talwarkers kind of a management. No, the hygiene has to be in place. Once the hygiene has been proven and validated, and you have to do your homework for that, right? Once the hygiene has been taken care of, if the stock is throwing tantrums on the downside, you should increase your SIP. So, for example, in a normal market, so let me take an example here. Laurus Labs. The stock was at 700 in or around 2021. If I'm an SIP investor, should I stop my SIP because the stock is at 700? The answer is no. The answer is no. So even in 2021, anyone doing an SIP in a Laurus Labs kind of a company where management is unquestionably very strong, one of the best managements in the entire CDMO space, stock is at 700, reasonably valued, if not like the chemical 2021 valuations or where Divi's Labs or Suven Pharma are today. It wasn't that kind of a valuation, and rightly so because it was pretty much ARV dominated business. But I wouldn't, if I'm an SIP investor, if I got a 10-year horizon, I wouldn't stop my SIP in Laurus Labs. So I'm just focusing on one stock. What I would do is, if in a normal valuation, I'm investing 100 rupees in Laurus on a monthly basis, in that kind of a scenario, I'll invest only 20 or 30 rupees because I know that the stock is not cheap. But I also know that there are a lot of momentum Spidermans in this market, and 700 can become 1000 very easily. So I will not stop my SIP because I know there are enough fools to take an expensive stock higher. And that exactly this scenario was playing out in a Gland Pharma after IPO or a Clean Science after IPO or diagnostic companies. There was absolute madness in 2021 or the PSU rally recently, right? Last year, that is. Because there were enough fools who started comparing, and this will always be the case in a in a in the best of the times. Tata Steel will look very similar to Nestle. So cyclical is once a cyclical, always a cyclical. Majority of stocks, even consumers are cyclical. So consumption is not a done and a given deal. So coming back to Laurus Labs, 2021, you are not investing 100 out of 100, you're investing just 20. And then when the stock falls to, let's say, for 450 and 500, you incrementally start increasing your SIP allocation. So you were investing 20 and you were saving 80. Let's say the stock um, did not correct from 700 for a couple of months. You have kept on saving 80 and 80 and 80 and 80. And then when the stock is at, let's say, 500, you double your exposure on a monthly basis. So now you are in deploying 40 or 60, depending upon your comfort level and your cash flow situation. And when the stock goes to 300, now you know that your downside is pretty much capped as an SIP investor. Your downside is not capped at 300 as a momentum player because 300 could become 200 tomorrow. But as an SIP investor, you can now increase your exposure from 60 to 70 or 80. And if the Nifty also starts crashing, so you get the combination, you get the deadly combination of hurricane and tornado together. So the Nifty is crashing and the stock is also crashing faster than the Nifty. Then you should be full throttle 100 out of 100 on a monthly basis, and your buying power of your money will keep increasing as the stock is falling. Because you're confident about your research, you're confident about the management and the people. And in this world of digital and social um, validation, news flow, the frequency of and the quantum of news flow is increasing all the time. You you tend to lose sight of the basics. You tend to lose the sight of the basic. And a stock that is falling, my recent tweet, it will be very discomforting to put more money into a falling stock. But in an SIP mode, when you are in an SIP mode, you are very unemotional and mechanical. So it's a staggered and almost mechanical buying. And SIP will let you sleep well because you are getting a paycheck again next month. And if the stock is down, that's even better because your quantity will be higher. Because ultimately, if it's a good management and a good business in a sustainable, larger trend, the stock will ultimately go up. So that's how I would tend to um, play stock specific SIP. SIP is the best. It's an anti-fragile mechanism. It's proven time over time, time and again. It's proven. You cannot, by definition, you cannot be losing as long as the hygiene checks are in place. If you do a 10-year SIP, even a 5-year SIP starting in a bear market kind of situation like today, majority of these companies will be multi-bagger in less than 5 years. It works. It's empirical data. And the power of compounding is people don't understand the power of compounding. Your 80-90% returns will come in 10% of the time, last 10%. The graph just goes up, up and away. It becomes almost unreachable. उसका gradient change होता रहता है. You will start very slowly. And that's exactly what this CDMO business is all about. It will start very slowly because your capex is upfront, your investments are upfront. And then it will slowly, that's the J curve classic. And at some point in time, the growth will be ferocious. I hope I answered it. And I see Aditya has also joined. Hi, Aditya.
Hi, Sajal bhai. Hi, Prince. Good evening, everyone.
Hi, sir.
So does that answer the question, Prince? Or is
Yes,
there
it
any
does, sir.
follow-up? Okay, sure. Thank you.
Yeah, it does answer the question. And then we move on to next question. So let me take this question to Aditya. So Aditya, the person is asking your position, I mean, in CRED's position in Thyrocare is public. So he's asking, however, its parent API holding had a valuation cut by 85% in 2024. Though this looks like cosmetic accounting, okay. However, will such volatility at parent negatively impact the future of Thyrocare?
So that's a fair question. I think, look, when you're investing in Thyrocare, you're a minority shareholder of Thyrocare. What shouldn't bother you is what is happening to API. Having said that, what had happened earlier is that API had pledged all of its shares that it owns in Thyrocare. They own 71% stake in Thyrocare. And API has kind of pledged all that 71% shareholding so that they can raise some debt to burn in their pharmacy business, and hence that was a challenge at that point. But post the recent rights issue that API did, where they raised money from the likes of Manipal, from the likes of TCG, Temasek, I think that debt pay down is just a matter of time. And the unpledging is also a matter of time, and hence from this point onwards, once they raised the money from rights, I don't really now bother with what's happening with API because it doesn't have a direct implication on Thyrocare per se. The only thing that happens because of this trouble that the parent is in is that Thyrocare tends to pay more dividend because the parent needs the cash to burn or operate. And hence Thyrocare ends up paying a substantial part of its profits as dividend, which actually works good for me as a minority shareholder. I get some dividend every year. So I think for the last 3 years now, consistently, Thyrocare is paying 18 rupees a share as dividend. Um, and it was doing that when it was 500 rupees stock, 300 rupees stock, and even today when it's a 700 rupees stock. So that's a good dividend yield, right? As I keep saying, being paid to wait. So I think a key trigger for Thyrocare stock could be the unpledging, and that unpledging could happen in 6 months, could happen in a year. Hard to say when that will happen. But as and when that happens, I would expect the stock to re-rate somewhat. Am I being paid to wait till that point in time? Yes, I'm getting dividends and the company is growing. So these are both metrics that help me keep my position and wait for the event so that, the stock can potentially re-rate post the event. Guys, standard disclaimer, I'm a fund manager at Incred Asset Management. My views are biased. Many of the stocks that I will talk about, I may have owned or I may own, and I may have, a bias or a vested interest. So please do not take these as buy sell recommendations. Take these as just opinions, and do your own diligence before you even consider investing in any of these stocks. I hope that answers the question, Prince.
It does, Aditya. Thank you. So, Sajal sir, next question is for you on the company Shri Ganesh Remedies. So, he's asking the company has kept on adding capabilities. So, he's asking about your reading of the business, if you have coverage or maybe. Sajal sir?
Sorry, I was on mute and started talking. No, so good question actually. I've never interacted with the management of Shri Ganesh either publicly or in private, but I believe they are doing all the right things. And I'll for your sanity check, I'll give you a very clear sort of thumb rule that how do you know that the management is making all the right calls as an example. So let's talk about number. I know most of you don't read annual reports, so the best way to find if management is doing all the right things is the last 2-3 years ka annual report padne ka and transcripts if they are doing earnings call. But I know in this social digital age, no one has got the time. So I'll give you a quick 5-minute screen. The quick 5-minute screen is you look at the cash flows of the business over the 10 year. And if there is a pattern emerging in terms of a rising operating cash flow, that means the business is winning. That means the management is doing sensible capital allocation. So if you look at Shri Ganesh Remedies, it used to generate or report an operating cash flow of sometimes negative and sometimes low single digit. Their last financial year operating cash flow was 30 crores. So almost 20x, 30x of what the operating cash flow used to be 5, 7, 10 years. And that's a phenomenal jump. That's a phenomenal jump. Then the other thing that I care about in these so you need to know the kind of the business is, what sort of material gross margin they are reporting today, and has this material gross margin inched up over the last 5, 10 years? And the answer in case of Shri Ganesh Remedies is a yes. And these checks, you know how much time it took me to do these checks? 30 seconds. So now in 30 seconds, I am interested to know more about this business. Now I want to read the annual report. Now I want to dig deeper. Now I want to go through their earnings transcripts. Now I want a pulse check on the management. That is this a sustainable growth? Is the margin sustainable? Is the cash flow sustainable? Or is it kind of a flash in the pan that, some external event or some capacity that has shut down, and that is the reason or the trigger behind this significant improvement? Is it sustainable or not? Precisely. So in case of Shri Ganesh Remedies, what I found out was that previously they were more focused on the API and the intermediates of pharmaceuticals. They have started changing their strategy towards specialty chemicals now. So they still want to do CRAMS or CDMO or custom manufacturing, but they want to do custom manufacturing for non-GMP. And in that context, I think is one of the best gross margins in the industry. So the only thing that I need to wait for is the stock to crash for whatever reason. And then at that point in time, I think it would be a good time to, because current valuations, I think, are pricing in what the fundamentals are saying. The margins are somewhere like 38, 37%, if I'm not mistaken, the operating margins. And that number may not be sustainable. I think for a business like Shri Ganesh Remedies, 30% or late 20s in terms of EBITDA is a more sustainable operating margin. So if there is an accident or a negative random event and the stock drops significantly, because I've done my sanity check, I've done my hygiene, I've read the annual reports, I've read the transcripts, I like what the management is doing. Now I need the margin of comfort in the price. If your horizon is a 10-year horizon in the SIP, then again the same Laurus example holds true. This is live now. So Laurus is hindsight 700 wala stock. This is live. So if your normal SIP would be 100, I would say you go with 20 to begin with. And as the stock starts falling, incrementally increase your SIP. Just do this as a pilot but you have to do this for 10 years. And most investors, they don't have that kind of a patience. The formula is proven. Formula is very simple and straightforward. All you need is a little discipline and an extra hour at your workplace so that you get a promotion and you get a raise, that you make more money in salary so that you could invest more in SIP. That's how I would put it.
Right, sir. So Aditya, next question is on Alchem Lab. He's asking, they are venturing into medical devices business and biologics through Engine. Not much details are available in the con call though, but he's asking about your views on the expansion of the company, if you correct that.
No, I do. So I look at it as a complementary strategy where they are already selling branded generics to the Indian doctors and patients. Why can't they use those touch points to sell medical devices? I think it's a complementary strategy, but obviously this is a space which is a white space at this point. There is no branded player per se doing medical device retailing in India. So, they have a wide space here. So if they execute well, it can be a very, very lucrative strategy. But as with any branded business, to create brand takes time. It takes a lot of effort, time, money. But once it's created, if it's created, it creates perennial cash flow. So I like the strategy, but we'll have to see as in how long it takes.
Right. So, sir, you want to add to this, or shall we move on to next question?
No, I think it's a good business. And see, their biologics play is an anti-fragile strategy. Why is it? Because they are taking the risk. It's a difficult space, but they are adding optionality to the business. I generally don't like businesses who don't add optionality. So because you're kind of moving to a new frontier, a space that most have failed or not been able to scale up, and you will glean some lessons. You will make some mistakes because you're new in that sector or space. You will make some mistakes. Probably you will learn some lessons and you will add value, terminal value, that is, to the business. So strategy wise, I think I like that strategy. Valuation, again, it's your call. Anything could go wrong, and we're living in a chaotic, disruptive world. But fundamentally speaking, I like what they're doing. But again, note a disclaimer: I don't own this stock. I've got no position.
Right, sir. Next question is
And
on
by the way,
Solara.
just one more disclaimer on the previous stock, Shri Ganesh Remedies. I'm not invested, but I'm tracking it as a disclaimer.
Right, sir. Thank you. So the question is on Solara. He's asking Solara CRAMS businesses where our thesis is now the business is demerged. Do you think one should shift to CRAMS once listed?
That's a hypothetical question. I wouldn't say necessarily the thesis is on the CRAM side because I jumped on Solara's earnings call and I spotted that the material gross margin ex CRAMs are also very healthy. So 52% material gross margin in non-CRAMs business. For an API business, it cannot be commodity by definition. A commodity business cannot make material gross margin. So I'll tell you what the gross margins of Laurus Labs are on the ARV API. It's about 35%, give or take, 35%. You go and see the margins that the IOL and the SMS Pharma are making on the commodity side, or Aarti drugs for that matter, right? Aarti drugs is also a commodity API company. You look at the material gross margin that these three, four businesses are making. It's significantly below or they're closer to 40%. Whereas if Solara non-CRAMS is doing 52% material gross margin, that means there is a competitive advantage. It could be a relationship with the innovators. It could be a relationship with big pharma. It, there is something in the business. It could be chemistry. It could be your tacit knowledge of, how to produce an API with a better yield and purity. It could be a combination of factors. But there is something in that business that's telling me that it's not commodity. So even the non-CRAMS business, I'm not too sure if I would be running to sell it if I get the opportunity. Yes, if that business goes to 6 times price to sales, where I think Divi's Labs should be. So Divi's, I think 6 to 8 times price to sales is a reasonable valuation. So if Solara non-CRAMS goes to 6 times price to sales, I'll definitely be a seller. But it depends, it's a hypothetical question when it will be listed. There is a long NCLT process that will take place. That may take another 18 months. That may take 24 months. Who knows, right? So I think it's jumping the gun if you're thinking from that perspective. The question the existing investor should ask is if Solara stock goes to 400 tomorrow and then 300, what impact will that have on your sleep disorders or your conviction? And if the answer is you will be as convinced at 300 or 400 as you are today. So again, same classic example of Laurus Labs. I was convinced in Laurus Labs in 2019, stock was below $70. I was convinced in Laurus Labs in 2021, stock was at 700. I did not sell a single share. Nothing has been sold. And the stock came to 280. I enjoyed that crash. I really did. I hugged the stock with all my might because I am playing a long-term game. So that's my question. Any stock that you are invested in, go back, go open your portfolio and go through the list of your entire holdings and close your eyes and imagine the scenario that each of those stocks start hitting 50% downtick tomorrow morning. How would you feel? And if you're as convinced, so Thyrocare, Aditya gave the example, right? Whatever the stock price is, so Thyrocare is 720. If Thyrocare opens gap down tomorrow at 400 or 350, how would you feel? And if the answer is your conviction will be unmoved, then you are in the right stock because price is not controlling your emotion. SCG, many examples. And if you think that, if the stock crashes tomorrow, there's a virtual 1:1 split without you getting any additional shares, and you would be very disturbed. You would jump on Twitter and see, what the chatter is, kya ho gaya, kaise ho gaya. Then you are probably in the wrong stock. Sell it tomorrow morning. So do this exercise with your portfolio at every stock level. If the stock is halved, will I be adding or will I be even more confused? If the answer is you won't be adding it at 50% lower price, all things being so, there's no fraud has happened, management is still intact, management is still same, all things being equal. If the stock is half price, will you be adding that or not? If the answer is you probably won't be adding it, and be honest with yourself. No one is judging you. So just be honest with that assessment. And if you think that you won't be adding that stock 50% downtick, sell it tomorrow.
All right, so thank you. So Aditya, next question is for you. He's asking, can you please ask Aditya a bit more detailed view on the NBFC-MFI sector considering Karnataka government MFI ordinance?
Yeah, so I'm not really very up to date with the Karnataka ordinance. What I understand on the MFI space at this point is that there is basically several alarms being raised by RBI, state governments alike, where they are saying that look, the MFI space is over leveraged. They have lent to the same customers. Several of them have given multiple loans, so there can be a default. And I'm not saying that it isn't happening. It is very likely happening. Many people in our country have taken multiple loans, and these are consumption loans. They're buying mobile phones, TVs, personal vacations from these loans, and that's going to end badly. That's definitely going to end badly. But that's not the point I was making. No matter how bad the situation, at some price point, it gets discounted in the price. That is my point. That even if I consider all these things to be true, which they probably are, today's price tells me that for many of these MFIs and NBFCs, it tells me that the worst is in the price. And hence I'm saying it needs to be patient capital because the stock will not move till things turn around, right? But the problem in the MFI space specifically, NBFC still you have larger NBFCs where you can invest, trade, get in, get out at the right time. You have more ability of timing it, right? But the problem with the MFI space is that if you don't get in early, if you don't get in before the cycle, during an upcycle, you cannot touch the stock. The stock goes from circuit to circuit. These are 2,000, 5,000, 4,000 crore market cap stocks, very little float. And private equities are there and institutional holding is there, promoter holding is high. You will not get any volume to buy any significant amount at the right time. Okay. So the only way to play this space hence is to sort of be early. You have to wait for your time. You probably not be paid to wait. The paid to wait concept in this situation can only come from probably dividends or can come from AUM growth, which I don't see coming because the moment AUM growth comes, the cycle has already turned. So the challenge in the MFI space is going to be that you will not be getting paid to it probably in any significant fashion. There might be minor dividends here or there, but no significant remuneration for your patience. So that is what makes it very interesting because most people will not do this, and hence today you have people saying sell on MFI and NBFCs regardless of the valuation. You read reports, you read the numbers. Valuations have look, markets behave that way, right? We know it. We have seen it multiple times. What is in flavor, regardless of valuation, buy. Don't look at 100p, 150p, 10 time price to book, 40, 50 times price to book. Doesn't matter. Buy. EMS stock, buy. Don't look at valuation. Defense, buy. Railway, buy. Don't look at valuations. It's okay. People who want to do that can do that. And it's their money, it's their capital, it's their, well-being. I don't care. My style of investing, I would like to buy when nobody's even talking about it. So today, MFI space, any guy you want to speak to will tell you avoid. When that happens, I know for a fact that the sector's fundamentals may not have bottomed out, but the valuations have definitely bottomed out. I mean, I am fairly convinced on this. But yeah, I mean, having said that, patience will be the key to making money in this space. And I tend to have generally loads of that. So for me, it's a perfect fit. May not be for everyone, to be honest.
Right, sir. Thank you. Sajal sir, next question, although both can answer, but I start with you. So what is the potential for CDMO business for Aztec? Will it be justified to judge its value in respect to historical valuations since the business mix is changing now?
Yeah, so that is the narrative that the business mix is changing now. Where is the evidence? Have they executed in the past cycle? So let me just quickly do a real-time screener of. I've not been following this stock after exiting in 2022 November, and I disclosed that if you go through my feeds, you will find. So let me see how CDMO, how real CDMO Aztec is. The operating gross margins are 35%. Period. There is no CDMO business on this planet Earth as on today that will report gross margins of less than 50%, material gross margins. So this narrative is validated that it's not a CDMO. It's a largely commoditized, fragile business that is always at the mercy of dumping from some country or the other, and that hasn't changed. And if I give you an example that why I sold Aztec in November 2022, the price to sales of Aztec then was 6x, and the price to sales of Newland Labs was closer to 1x. A much superior business at 6 times cheaper valuation with much more sustainable structural tailwinds. Why do you think one should not switch? So coming back to the question regarding Aztec's CDMO capabilities, yes, the business as on to here and now is not the right way to look at the business. You have to look at the terminal value. Godrej management is good, right? And they will create value over a period of time. But I would like to see an initial sign of margin, gross margin. I never care about the operating margins in a CDMO business because I know the operating margins can fool you very easily. It's the gross margin. Show me an upward trajectory in the material gross margin. You look at any real CDMO, whether it's Newland Labs or any other company, the material gross margins will be closer to 60%. And now there is a catch here. The pharma material gross margins will be generally higher than the chemical CDMO gross margins because you do a lot of value add upfront, but then there are your operating expenses are higher, your chemical plant operating expenses are lower, so your EBITDA will be much more normalized in both cases. So Aztec can easily report a 35% EBITDA margin on 55% gross margin. But where are those gross margins? So today Aztec is not even in my top 10 when it comes to the CDMO side of things. I can always play Aztec like a commodity. If it's 2 times price to sales or close to that, I would be much more comfortable buying an Aztec around those valuations. Again, I could be wrong, but that would be my kind of broad thesis that the business has to, because when I initiated Aztec Life Sciences in 2012, the valuations were 0.4 times price to sales. It was ridiculously low valuation. So it was an anti-fragile trade. So I look for asymmetry. I look for situations where I cannot lose. So clearly, Aztec, I'm not too sure if it's in that situation, given what's happening in this CDMO. And I can tell you hand on heart that CDMO earnings will surprise big time in FY26 and again in FY27. And then all those momentum punters will start loving this space.
Aditya, you wish to add something to it?
No, yeah, I think Sajal bhai has summarized it well.
Right. So next question is on the standalone healthcare insurances sector. So as the person is saying, as valuations here also at their lows, lots of noise around Star and Care via Religare. So general view about this sector, Dr. Santosh Toshi is asking. Maybe if you track, you can add. Otherwise, we move on to next question.
Yeah, I've never tracked Star Health, but I know the stock hasn't compounded. See, I get worried when I see institutions holding a stock and no compounding since IPO. I I mean I tend to get worried, honestly. When smart money is already positioned, why the stock is not doing well? So I highlighted that in Orchid Pharma yesterday in one of my tweets, right? When I bought Orchid Pharma, institutions were holding 2%. When I sold Orchid Pharma, institutions were holding 19%. Why is that? If institutions are heavily invested in a stock because they are short term by nature, they cannot let their NAV sacrifice. then the stock should perform. Then the stock should perform. So the shareholding pattern is slightly puzzling in Star Health, and given the fact that the stock hasn't compounded since the IPO, which is a long gap, and the fact that insurance and banking are highly regulated industries. And in these kind of industries, a random, you got to be very careful about a random event. So from that perspective, I think it's a pass for me.
Yeah, for me, I think standalone insurers, specifically health insurers, uh, I would avoid simply because it's nothing specific to, I think, Star. I think it's more about the business model. I think the healthcare insurance industry in India is still very, very fragmented. You have a bunch of PSUs, you have a bunch of private companies, and then you have, regulations which are not as tight in favor of the insurance industry in that sense. So it sort of creates a problem for the underwriter to create enough cash flow and enough profit. So it's a space that I've looked at. It's a space I thought is ahead of its time for now. Let the industry consolidate. Let there be fewer players who have more bargaining power. Not to sort of mention that even the government is competing with the private insurers through Ayushman Bharat and all that, right? So it's a competitive space, fragmented space, no pricing power per se, no loyalty of customer, and to that lose regulations, which the consumers basically use to their advantage. So I would avoid this space. The macro of the space itself is pretty unhygienic at this point.
All right. So next question is around, given the high operating cost in assets abroad, is that a bane for the companies? Although the question is specific to Piramal Pharma, but in general, I would try to understand that the companies which have assets abroad, does it apply to all, or there are advantages as well?
So I'm not following the question, Prince. What is the question is on Piramal or sector as a whole? Any company that is suitable for Mover, Dishman, all of them.
So the question is from the person who's specifically asking about Piramal, but just want to understand how it goes. If in general we want to understand.
So from an from a footprint perspective, I think it makes sense to have a diversified footprint because customers definitely take it positively. So Piramal Pharma having US operations as well as India operations make them much more viable, integrated because you are closer to your customer in terms of the time zone, right? So West Coast US versus India, the time zone is ridiculous, or even the East Coast of US. So if you have got presence on US soil, geopolitics wise, you are better placed in this current scenario. But even otherwise, if there is a heavy globalization going on, even in that context, sterile injectables and those kind of pockets, it always pays to have your facilities closer to the end market. So Spokane of Jubilant Pharma is another such example, right? And so that's one. The other thing is, yes, your operating expenses are higher in a jurisdiction like US, but your gross margins are also higher. So a company like Piramal Pharma can easily make 85% gross margins in certain product categories. And as long as you're operating those plants where your gross margins can be 85%, even with a high operating cost, you can report 25% EBITDA margins easily. And you also get, a diversified footprint of manufacturing, which in the current scenario where innovators are spooked and they are moving away from China, it gives them a good option to partner with a US-based local manufacturer. And so is the case with a Dishman, and so is the case with Jubilant Pharmova. So if I'm having five, six CDMOs in my portfolio, and I will never settle with one CDMO because the randomness is so high. So in that basket of five, six CDMOs, will I be looking at Piramal Pharma? The answer is yes. ADC is another angle that we discussed yesterday, and a clear disclaimer that I'm a interested party. I'm invested in Piramal Pharma, But I like this company from a regulation perspective. There have never been any US FDA, none. Even Divi's has had US FDA challenges. Even Natco has had US FDA challenges, but not with Piramal Pharma. So that's a double thumbs up for me. And when I say challenges, I'm not referring to observations. It's by nature you will get some observations. The problem comes when you get a warning letter. So Indoco Remedies, these are bigger mistakes. These are blunders. Getting a warning letter. So Natco Pharma got a warning letter. They're still serving that warning letter. Indoco has had a history of repeat warning letters. So that is a clear red flag. Whereas if you're getting an observation, so if I go for my driving test today, I've been driving a car for the last 30 years, I will get observation. Getting an observation is fine as long as it's not a data integrity or any of those kind of observations. So yes, Piramal Pharma has got an impeccable track record of regulatory compliance, and now they are into the quote unquote future hot sectors, ADCs and peptides. These two pockets for the next 10 years um, will be very attractive. So what are the good pockets? So again, I keep saying cell and gene therapy, antibody drug conjugates, peptide drug conjugates, synthetic peptides, complex high potency small molecules, oncology, orphan drugs, rare diseases, any drugs that are going into rare disease. These 5, 6 pools are decadal uh, themes. But if you want to meaningfully play, then you have to have a basket of 5, 6 CDMOs and your allocation can flex. If something is really expensive, you can have a reduced allocation and you add more to another in the same basket which the stock hasn't done well. So you can keep flexing between that bucket or a basket of 5, 6 stocks. But yeah, Piramal Pharma, I'm invested again as a disclaimer and I like this management. Very honest and they never try to please anyone. Upfront, candid. Yes, Carlyle was a mistake. They shouldn't have roped in a Carlyle. They should have probably have gone for a KKR or a Eight Roads or, a True North time kind of a private equity. But again, we all make mistakes.
Aditya sir, do you want to add or?
Nathan's. Let's move on.
Okay. So, very basic question. I think we have covered, but since it has come again, so, sir, if we have to make a comparison, say, something getting into agreement in the Japanese market vis-a-vis in the US market, which one will you rate higher, and what are the potential reasons for that?
I didn't quite get the question, Prince. Japanese market versus both are reg markets, both are regulated markets. I mean, Japanese are slightly much more stringent than the US FDA. So a Japanese regulator will be very stringent relative to US FDA, but I did not quite catch the question.
So question basically was, say, two companies, one is able to crack, say, Japanese market and other is US, although the economics would be entirely different for both the companies. But capability wise, which company will you rate higher, or this won't be a fair
So,
comparison to say?
well, if you put a gun on my head and ask you, I mean, I would go with Japanese because that market is difficult to crack. That market is difficult to crack. Japanese are very stringent. Japanese are very particular. There are lot many companies selling NC APIs in the US vis-a-vis Japan. Again, Japan is a smaller market, but even if I adjust for that, I think Japan is a tougher market to crack, and that's why some of the companies that I'm invested in, so Newland Labs and Hykel as an example, they've got good, very strong clientele and presence in Japan, and not all of that may be in the numbers today, but these companies have proven their worth. And also on the chemical side, many companies are actively looking for Japan, but not every company is into NCEs. So if you are in an NCE space and if your innovator is a Japanese innovator, it kind of tells you a lot about the competence, the capability of that company.
Right. So, Aditya, one basic question is how to evaluate businesses operating with multiple subsidiary companies across the globe and doing a lot of RPTs.
So when I look at RPTs, I always look at consolidated RPTs. So if you have subsidiaries, you will have in standalone, you will see a lot of RPTs. That is not a cause of concern at all. Because any business that the parent does with the subsidiary gets captured in standalone related party transactions. But those transactions, it's absolutely fine. I don't think one should bother about those transactions because anyways, when you are buying a stock, you're buying the consolidated entity, which includes the parent and the subsidiary. So there, I don't have any problems. I have problems when the consolidated entity shows related party transactions, which means the company that you are buying is doing business with the company where the promoter has a vested interest and hence it's a related party. That is where the transfer pricing, the margins, the taxation, all of that becomes a little gray and hence we want to look at it with a closer lens, right? Now coming to, sorry, one second. Coming to the thought of, uh, sorry, Prince, there was one more part to the question. I keep
Yeah,
dropping you.
multiple subsidiary companies across the globe.
Yeah. So companies that have multiple subsidiaries across the globe generally tend to have them because they have business in certain geographies where they need to incorporate an entity, need to book some profit in that entity, and need to pay taxes in that geography. That's how taxation kind of works. So those structures are made for multiple reasons. Sometimes it's business reasons, sometimes it's a taxation reason, sometimes it's a government policy reason. So they need to have those subsidiaries. So when you are evaluating these companies, evaluate them on a consolidated basis. That's gonna be my answer.
Thanks. So there's a couple of questions on Shivalik Rasayan. So broadly, I would request you to
Yeah,
share your
sure.
view on the business.
No, it's fine. I mean, because I've already presented in detail Shivalik Rasayan on my anti-fragile, I can be much more open. Again, with a disclaimer that it's not a recommendation. I'm invested in this stock, and it's a recent entry. It's probably the last couple of months, 3 months max. So I've been tracking Shivalik Rasayan for good 7, 8 years now, so 6 years for sure. So 2018-19 period is when I started tracking Shivalik Rasayan, but I never bought the business because A, it was high risk and unproven. Because the areas that they started moving into, a commodity or near commodity chemical company going into a specialty API, having aspirations for US FDA are all clear red flags for me in terms of investment opportunity perspective. So I thought I'll wait and watch, and I the moment they got US FDA approval on an onco plant got me interested because I've been tracking it. So they got this approval back end of last year, if I'm not mistaken, and I've been through the annual report. So I look for three things in terms of validating the management. How do you validate a management that is not doing an earnings call? How do you validate a management where there is no presentation? How do you validate a management when you have never met them? You go through the last 5, 7 years of annual reports and you look for pretty much three pillars. So figure 8.4 in my book, those who have read it. I look for clear and consistent long-term goals across last 5, 7 years of annual report. Clear, consistent goals. Then I also look for a genuine appreciation of resources and capabilities. Company should know what resources will be required 5 years out, and it should start positioning itself accordingly. That's the second indicator of management quality. The third indicator is, do they understand the complexity and the challenges in the competitive environment? So, reading through Shivalik's annual report, I could validate all of these 3 points. I won't go into the detail because it's a very long, then, the whole 2 hours will go into this only. But I got green flags across all these three dimensions. And then it's a matter of time when the successful execution will happen. Then, as I was reading through those annual reports, there was some pattern that came and got my attention. Between 2011 and 2017, do you know the R&D investments of Shivalik Rasayan? So 2011 to 2017 put together, they invested zero in R&D. And 2018 to 2024, 55 crores. So that's a sudden surprise. What has happened? Something material has happened on the strategy side, because a company that has never invested, a chemical company not investing in R&D, it's a criminal offense, because you don't deserve to be called a chemical company if you're not investing in R&D. So even that tick was there, that significant exposure. So capacity to suffer pain, because if you're investing in areas where you're not comfortable, you're hiring resources from proven organizations. So they've got scientists who have worked in tier one organizations, pharmaceutical companies in India, with all the experience. And you need to spend money in R&D. You need to spend money in hiring people and all the rest of it. So all that was green tick. And then if you look at the employee cost of Shivalik Rasayan, the employee cost is closer to 17-18%, whereas the average employee cost of a chemical company, so let's take PI Industries as an example. If you take PI Industries employee cost as a percentage to sales, it will about be 8 to 10%. And Shivalik Rasayan is a good 800 basis points above PI Industries from chemical perspective. Now, if I say Shivalik is also having a US FDA approved onco plant, where the employee cost will be higher as a percentage of sales, then I would compare with the pharma tier one. So I would say, what is Divi's Labs employee cost as a percentage to sales, and probably the number is about 12%. So again, the higher employee cost as a percentage of sales tells me the clear the biggest indicator is that there is a deleverage in the business, because you're paying your employees and you're not generating output from them. And that's the nature of this business, this industry as a whole. Laurus Labs has got a very high employee cost as a percentage. So if you go to Laurus Labs P&L, you compare what the employee cost was in 2021, when the business was optimally utilized, or the capacities were optimally utilized, versus what the employee costs are in Laurus Labs today, or last quarter when the business was, or last fiscal when the business was not running at optimal utilization. And if the employee cost as a percentage of sales is high, it means that there is a deleverage in the system. Even in case of Newland Labs, for that matter, the employee cost will be higher than Divi's. So A, they are paying their employees well, and B, there is deleverage in the. So again, in Shivalik's case, even that kind of take, and then went through the S curve, so it kind of sounded like a stock with closer to point A. So rule one was being met. And rule two, I was looking for a forward rate of change. So in terms of the forward rate of change, um, I created my mental model. So I read a lot, and my reading helps me in creating mental models, which typically you may not find in an investing book. And I created the mental model that, this story will incrementally turn better by the, so currently on the, so today they've got three units, three plants, two on the agro side and one on the pharma API onco one. Only one plant is getting optimally utilized. So the other two plants, the agro as well as the pharma, they are underutilized. Pharma is much more underutilized compared to agro. So the unit one, or the old unit is paying the price of the other two units. So they are kind of a parasites, if you like. And that's why the margins are where they are, because majority of your capacities are underutilized. So that's a good place to start with. So what I expect going ahead, again, no one knows, it's a random, chaotic, disruptive word, and no one can predict the future. But my mental model suggests that starting FY26, the agro import substitution, so the new agro plant is playing the import substitution theme. That should incrementally do better. There may be an incremental traction on the onco pharma side, because currently pharma is all but dead. It's very small sales that are happening on the pharma side. So FY26 should be turning better even for pharma, and these two put together should result in an improvement in EBIT and PAT. Then if I roll it over to FY27, then I see both the twin engines of our agro and onco, they should be revving up, and the balance sheet should be much more healthy in terms of, if you look at Shivalik Rasayan's inventory days, the inventory days were very unsustainable at 328 days or whatever. But if you look at the long-term historic average of Shivalik Rasayan, their inventory days have always been in double digit. So what went so wrong? Is the agro pain. The whole industry has been suffering with channel destocking, and that's why the inventory just went through the roof. But then, as we get the annual report year ending March this year and going forward, what I expect to see is inventory days normalizing again. So again, same classic rule one and rule two getting matched. And in my analysis, I always look at the standalone revenue of Shivalik, and the reason is that console revenues must not be looked into because it's the associated business. So Shivalik is the controlling, having a controlling stake. Shivalik is the parent of another company in the pharmaceutical space called Medical and Bio, and they consolidate all the sales of Medical and Bio in Shivalik in the console numbers. And the reason is perfectly legal to do that because the same board and control is across both companies. But I tend to avoid the console numbers, so I'm only looking at the standalone numbers. And I think in the standalone numbers on FY 2 years out, there should be a material jump in the sales. And because if it's a high operating leverage business, if your sales double, your EBIT and PAT will be much more than double. So your return ratios will start improving and so on and so forth. So that is kind of that was and that is today my broad thesis on Shivalik Rasayan.
Thank you, sir. So, Aditya, although Sajal sir has already shared his view on Syngene, but again, the change of CEO, so what are the expectations and what you believe can be changing going from here?
Yeah, I don't have anything further to add. Yeah, see, the older CEO was probably not doing what was expected of him in terms of growth and bringing business to the company. And the newer CEO seems to have a better track record. So let's see once he takes charge of the proceedings how well he delivers. That will talk a lot about whether it was correct to replace the older CEO or not. But on the face of it, looks like a good initiative. Let's see if it pays off.
All right, sir. Sajal sir, although you have shared
Yeah,
your
no,
view,
so
but
that's
in
fine. I
case
mean, I
you
can
wish
only
to.
share what I have already shared in my other because
Perfect.
it's an anti-fragile channel. I don't want to. There are two, three data points that are very interesting in Syngene, but I have not shared it with my anti-fragile subscribers, so I will not be sharing it here. But I'll give you some of the other important points. Terrible leadership. Let's assume that Jonathan Hunt was, not fit for purpose, and I believe so. I've said that. It's been a lost decade for Syngene. If I do a CAGR calculation of Syngene with that kind of a low quality management, so to say, low quality in the sense of growth aspiration, not integrity, I get a CAGR of mid to high teens in Syngene. As on today, when this stock has not been doing well, so it has corrected from 850, 900 all the way to 700. Even today, Shivalik, not Shivalik, Syngene is reporting a better CAGR, Aditya, compared to Thyrocare. Thyrocare is pretty much flat since IPO. 2016 का IPO है. Thyrocare अभी भी मोटा मोटी वहीं पे है. Syngene is still reporting a good 18% CAGR from the IPO price. That tells you something very interesting. Doesn't matter who the management is. The business is fundamentally so solid that it can run on a single engine, i.e. the engine of business itself. And if you look at the operating cash flow conversion, so EBITDA by OCF for Syngene, it's best in class, better than TCS or any IT services, forget iPharma. In a capital intensive sector, if you are converting majority, almost all of your EBITDA into operating cash flow, that business cannot be bad. If you're reporting the best working capital cycle, you compare Syngene with any of the either the IT services or DVs. Syngene is head and shoulders above the working capital days. So when the balance sheet is in a pristine condition, when the operating cash flows are rock solid and better than anyone, in the industry kind of gives me a lot of comfort that, it's just the additional tailwind of a growth hungry management that is missing. And Peter Baines, as I said, he left a very beautiful platform for Jonathan Hunt to execute and deliver. So when Peter Baines was the CEO up until 2016 after the IPO, when Jonathan came, right? And he spoke about tectonic shift. In if you open the recent earnings call of Syngene, if you search on the keyword tectonic, Jonathan is talking about the tectonic shift of industry moving away from China, and that's correct. But I was also expecting tectonic shift in CRO to CDMO, so, and that's where Syngene has disappointed. That's where the management execution has disappointed. The Mangalore API, I've documented it, in pages after pages and paragraph after paragraph in my book. I mean, 1,000 crore of investment is sitting idle. That's not healthy capital allocation. But given all these pain points, the business is still reporting a good, decent CAGR long term, and the best operating cash flow metrics, and the best working capital, one of the best balance sheets, and the sky is the limit going ahead and over the next 10 years, given what the geopolitics and the global landscape is. So putting all things together, there is something in this business where even an average management couldn't kill the business.
Right. Aditya, although in last conversation we have spoken about Morepen Labs, but again, price is something which dominates over majority of the retail investors' mind. But apart from that, in such kind of businesses, what are the key monitorables or things to look for?
Yeah. So Morepen, I think, it's a good company. They took time to realize that they were a good company. They actually, Surisa took his own sweet time to realize that in the medical devices space, he had a first mover advantage, which he could have used to create a brand in that space. We was just discussing that medical devices space in India is virtually unbranded today. It's a white space. Uh, so, Morepen could have leveraged that long time back, and they were just alone in the space. There was absolutely no competition. Uh, but sometimes people get distracted. I think the promoters got or the management got distracted with the API business. They thought there was more money to be made there, and then probably came a realization that it's not it's not that easy to dominate in the API space. And now the focus has shifted back somewhat, I feel, towards the medical devices space. Prices have corrected, I understand. Are the prices exactly where I would want them? They're close to where I would want them, to be honest. And if I get some confidence on how are they executing the medical device business now, probably I would evaluate it. My only thing is that, even though they might say that they are doing it and they're wanting to do all the right things to incubate the devices business and to further grow it, I would like them to do it first, because, that's something that they've just failed to do in the past. So I would like to see some execution before I dive in. That's my only, you know, submission here.
Right. Sajal sir, you want to add on this?
No, I largely agree with Aditya's view there, and just to add to what Aditya said, if I want to buy Morepen, I mean, how will I get the benefit out of this diagnostics or medical devices business? I mean, will this be an IPO, and the money will come into the balance sheet of Morepen Lab? In that scenario, I won't be interested. If will this be an outright demerger? Probably that would be an interesting bet. And then again about the timing and all the rest of it. So I think what's the strategy going ahead in terms of the medical device business is rather unclear. So um, I wouldn't be keen on, because everything has crashed, right? In this market, everything is down. So now I can pick and choose what I want. So in that sense, I mean, Mopin will not be at the top of my pecking order today.
Fair enough, sir. Anil Reddy is asking about Praj Industries. Is asking, given the company's long-term ambition to triple its revenue by, say, 2030, do you think this decline is a short-term blip due to sector-specific headwinds, or does it indicate any deeper structural thing? Is
Well,
the question.
it depends what happens in future, and future is unpredictable. So there are the only so Praj has got many angles there. There's zero liquid discharge, there is hydrogen story, there is even high purity water for semiconductors, and it's all that in their annual report, right? So I'm not making it up. But two, three things have happened, and the majority one is US almost taking a U-turn from climate change. So if everyone is comfortable with running coal-fired power plants and polluting the environment and releasing CO2 at a faster pace, then in kind of an environment, Raj story will take a backseat. But is that the only reason why the stock is correcting? Probably not. I think the other reason is the management change, I think, is also happening. So I think in ex Honeywell, if I'm not mistaken, is coming. So there may be some nervousness in terms of investors because management change always is a zero or one event, right? Prima facie, looking at the resume of the incoming CEO, I think there is no reason to be concerned. But again, you don't know what you don't know. Future is always unpredictable. And then the third angle in Praj is, majority of their existing cash flows are government capex dependent by and large, or government policies dependent. So sugar policy, if government changes, Praj takes a hit because Praj is the direct beneficiary of ethanol story, converting sugar into ethanol. But I think the story is also interesting from another angle that there is another grain-based fermentation or distillation which will likely pick up. So bioenergy side, I think, is the only engine that is by and large driving Prash today. But then there is compressed biogas and of course longer term you have got these semiconductors and hydrogen and sustainable aviation fuel is another. So they have got five, six serious cash flow triggers in Praj. I would, from a structural perspective, I don't think anything has changed. Industry 5 is definitely happening. And we are currently in Industry 4, but Industry 5 is definitely happening. And businesses which operate in this world of, enzymes and fermentation and biosciences will be in a very strong position 5 and 10 years out. And some of these businesses, not necessarily Praj, will be quoting at ridiculous multiples because, by that time people will realize that, there is no looking back. But yes, it's not a here and now story.
Right. So thank you. So Aditya, basis the fact sheet of December last year, I can see that hospitals and diagnostics you were overweight on, and branded generics and API is somewhat comparatively underweight, not to say insignificant. But again, so the question is simple: is there any change in that sectoral analysis basis this volatility in the market? I mean, the reason the question coming is because a lot of value is coming across pocket, or does the sectoral analysis or being overweight, underweight remains the same?
No, I think broadly sectoral analysis remains the same. What keeps changing is the valuation of these companies, right? So I think I am the villain here, where basically I spoke so much about branded generics over the past 4 years that today I find it difficult to find value in any branded generic stock. Not to say that the business model has deteriorated or it has become worse. No, business model is just the same. But the valuations have just reached levels where, uh, to remain sort of bullish on branded generics, I need enough number of stocks to deploy capital, but I don't get enough number of stocks at decent valuations to deploy capital in branded generics today. Hence, that minor underweight that you're able to see is a result of valuations and not so much anything to do with the business. Same goes for API, the CDMO story is strong, but the valuations are perhaps running still ahead of that kind of story. So, you know, again, not finding enough opportunities to deploy. And this is your December numbers. So remember, the recent correction was not there in December. So keep that in mind. Um, and yeah, I was still finding value in hospitals and diagnostics at that point in time, where I was feeling comfortable deploying capital, given the risk reward those stocks were offering. So it's just a function of that, Prince.
Thanks, Aditya. Sajal sir, one question is on Newland. The person is asking, since it has corrected 30-35%, are the valuations reasonable now for an SIP investor as major growth is expected in FY27?
No, so major growth maybe in FY26 as well. For an SIP investor, I think definitely. Again, same template. If you were investing 100 rupees at the valuation of 2022, should you not even invest 40 or 50 today? The answer is you should. And you should be comfortable taking it all the way to 200 or full throttle, if the valuations become cheaper from this point onwards. I'm not expecting Neural Labs to report a stellar fourth quarter, and let me be very honest, because they have guided this very clearly that FY25 will be a flat year. But FY26 should be a meaningfully better year for Neural Labs, and then I think FY27 should also be meaningfully better year, because the two, three molecules. So in this CDMO business, now at this scale where Newland is today, just two molecules can change the whole complexion of this story. And I think the incremental CDMO revenues in FY26 should be positive compared to where we exit FY25. So fundamentally, structurally, nothing has changed. In fact, I think it's even getting better with this fresh capex of peptides, because a conservative management announcing a capex, it tells you a lot about their confidence on the future cash flows. So yeah, from an SIP investor, I think there is nothing to be worried about. An SIP investor could have even invested, 10% at 18,000 for that matter, because you see that's the template, that's your discipline. You will never go to zero, regardless of where the stock is. But you will flex your allocation on that stock given the valuation. So if at 18,000 you were investing 10% of your assigned budget for that stock, today maybe 40%, 50%. Again, clear
Thank you,
disclaimer
sir.
that I'm an interested party. I've been a 20-year investor. So those who don't know, I first invested in Newland Labs in March 2004. And I've never been zero holding in Newland Labs since. So again, that I think 20 years is a decent benchmark to compare an SIP. SIP should not be measured or judged on the 3-year or 5-year outcome, because the stock being lower, the SIP is anti-fragile. It's a win-win trade by design. If the stock is falling, your buying power is winning. And if the stock is rising, your buying power is losing. So you never lose on both ends.
Perfect, sir. Aditya sir, the question is, how do you judge a small company if it is growing very fast, but it also is accompanied by large receivables?
I think I don't know, Aditya is on mute, but I think it's a clear risk. If your receivables are growing much more faster than your sales growth, that's a clear red flag, because you're pushing sales. You're offering something for free, or you're offering discount, or in terms of payment. So you're saying that, take my sales, and even if you pay me next year, that's absolutely fine, because at least I can show a glorious looking P&L. And doesn't matter, most investors in a bull market, they will never look at the receivables growth. So if your receivables are doubled YOY, and your sales growth is 20% YOY, that's a clear red flag. But again, you need to look at the longer term trajectory. Is this a one-off event? uh, you need to quiz the management if they are doing earnings call, that why this time around the receivables have jumped significantly higher than your sales. You should also look at pattern should be there. One quarter plus or minus should not be the make or break in the thesis, but generally speaking, if receivables are running much ahead of or much faster than the sales growth, that may be discomforting. Aditya?
I think sir got dropped or maybe connection issue. Let me check with him. Meanwhile, sir, one question is, one second. Sorry. Uh, Yeah, sorry. So the question is on the consumption side. So Vinay is asking, in consumption, branded textile like Lux Industry and Rupa looking good in terms of price to book or price to sales. What's your view? So let me reframe this question. Sir, what kind of valuation frame should we use in such kind of companies is something a better of a question, I
So
think.
the thumb rule is you go through the mean valuations, any business, any sector, any stock. You look at the 10-year valuation in terms of multiple parameters, price to sales, price to book, EV, EBITDA, and better is the EV to CFO or cash flows. And so all those 5, 6 ratios, you look at what the average has been over the last 10 years. So you record those averages. Then you ask the question, has the business, what has, how has been the business velocity over the last 10 years? Has the business fundamentally improved to justify a higher valuation? So is it the same business? So Laurus Labs, again, keep going back to that example, or Newland Labs for that matter. So let's take a different example, Newland Labs. Newland Labs in 2014 was majorly into commodity APIs, majorly. Their CDMO was a very small fraction. So if I'm taking a 10-year mean of Newland Labs, I must be cognizant of the fact that the business velocity has improved dramatically in the last 10 years. So the mean will be fooling me. Because I cannot expect the business to come to anywhere near the mean level, because Newland Labs of 2014 is dramatically different compared to Newland Labs of 2024. But if you are operating in a commodity like a textile, again, branded textile is not commodity. Let's take a better example of metals as an example, or sugar or paper as an example. So if I'm analyzing a sugar stock or a paper stock, I will jot down all these 5, 6 parameters on a 10-year average basis or mean basis. And then if the stock is below that 10-year mean, I would be, I should be able to muster the courage to buy it. But then that's only fulfilling my rule 2, which is at the bottom of the business cycle. I'm still worried about my rule 1, which is the rate of change going ahead. Because for me, rule 1 is more important. The rate of change should be clear, it should be measurable, and I should be able to get a good sense check on how much will be the wait period, because I don't want to buy a business at the bottom of the cycle and then wait forever. That can easily happen with these commodities. The cycle is just not turning. So HIL, as an example, in building materials, it has been falling and falling and falling. The cycle is just not turning. But now with this government push, on the tax incentives, etc., there is there is there is hope. Again, we need to look at least one quarter. It may be Q1 of next year, or it may be Q2 of next year. Probably Q1, because monsoon season, the sales will not give you a breakout. So I think Q1 of HIL will be a good indicator to just see the breakout is happening. But coming back to the textiles, I think there are many good. I think there's an apparels company. I think SP Apparels or something. They're good quality companies even in textiles, for that matter. Ambika Cotton for that matter. I've never looked at so Page Industries is again, but the valuations for Page Industries will be much higher than a Rupa. So let me just have a quick look at Rupa, and just a very quick stethoscope check in terms of, yeah, the stock is struggling. I can see that what has been there. So its historic ROCE has been in 20s, so 20%, 25%. They have consistently done upwards of 20% ROCE in their upcycle, which is positive. And if the current ROCE is 8-10%, I think that's a thumbs up, because it's always good to buy a business when the reported ROCE is much lower than what the business has done. And again, I've got no handle on the management, so I don't know how good is the management or how trustworthy the management is. And then if I look at the cash flows, I think most years they have reported a positive operating cash flow. And then if I look at the margins again, employee cost and all the rest of it, I'll be just looking at the expenses and FSC, the average employee cost was 2, 3, 4%, and at the there is probability of improvement, but I don't see there is no employee cost is still near the average. So give or take, let me just quickly do a mean, very quick check. So I think market cap to sales is a good indicator. So yeah, I think long term Rupa is below its long term market cap to sales, so that's a positive indicator, I think. So I think given what I see, looking at the screener, and again, I've not met the management. I don't know what the management quality is like. And management is still 73% shareholder. So again, if they have any other, it makes sense to maybe just nibble it a bit. Don't go overboard, because unless you know everything about this business, and maybe you can. This is a point where again, I don't know what I don't know. Someone can start an SIP at this point, because the incremental downside may be capped if you have got a 3-year horizon. Because it's a kind of an essential consumption in a business that has reported 20% plus ROCE in previous cycle. It's got no reason to not be able to do that. Which one was the other stock other than the Rupa, Prince? There was another one.
Lux Industries.
Lux as well. ROCE there. Because again, it's earnings growth and ROCE. So again, Lux, I see they've reported upwards of 30% ROCE in the past cycle. Cash flow, yeah, barring 1 or 2 years is positive. Again, it's a very quick sanity check. And operating margins, they used to be in double digits. Now they are in 8-9%. So yes, I see there is pain, santap as I call it, right? So there's definitely pain in this space. If I quickly look at the price to sales long-term mean, yeah, clearly there is pain in this. So maybe the incremental downside is later. Both cases. Yes, I'm mistaken. And again, checking you a very quick 6 seconds. So don't start thinking with my analysis, because again, management is the key thing. So if you know both managements, Lux and Rupa, go with what you think. To just quickly take this, I'll be back in 5 minutes. There's a phone call. I cannot
Sure, sir, please. Yes. Okay, so no issues. So friends, let me utilize meantime for disclaimers again. As we always say, the idea of this session is purely to share what we think about the companies from our understanding, and definitely by no means to influence anybody's views. Yes, you can always take these sessions as a starting point, so as to aid your research, your understanding of the businesses, because that is going to help you in the long term. And definitely, if your horizon is less than 3 years, there will be high chances that if you are simply looking for names, there could be potential disappointment. But if your horizon is long, and maybe if you are doing the SIP format, definitely the things would be much better, rather than not doing any due diligence and simply going by names. That is never the intent, and that is not going to help either. And I think majority of the questions I have already taken, but again, if there would be more interesting questions, and if Sir joins again in 5 minutes, we will take a couple of questions. And anything more, you can always write in the comments or maybe DM me. So in limited capacity, we try to cover all the questions. There would always be a case that we miss out on 1 or 2 questions from you. So don't think we are not taking your question. That is never the intent. But again, the quality of question is something which we look for, because it is a two-way communication, wherein good questions from you guys really help us get better answers. And definitely, if there would be some points from there which ourselves also find those pointers from business standpoint to evaluate more. So definitely win-win situation for everyone. But yes, if there are more questions, you can surely write in the comments, and I'll see how many of those I can take. So I'll pause here and we'll wait for Sir to join, and we'll start again. And one more thing, like we had a 1 hour or 1.5 hour session yesterday also, so that has already been published on YouTube and is available
Yeah, Prince,
for
I'm back.
everybody. Yeah, please, sir. You can continue
Uh,
from there.
so, are we done with the questions? Are there any more left in the system?
Yeah, there are a few more
Mm-hmm.
questions, so let me. Okay, so generic pharma do not have any impact of tariff. Will CDMO suffer from tariff? Appears to be a vague question, but maybe.
Again, we don't know. See, geopolitics is something that is incredibly difficult to call out, but again, it depends on the bargaining power. I think US has an inferior buying power in the CDMO space because they are exiting China, or that's work in progress, so they cannot exit or alienate two countries at the same time, right? So I think common sense says that um, Indian CDMO story should stay intact regardless of whatever this tariff tantrum that is happening. That would be my sort of broad brush. But again, it's a random daily news flow. Again, management, as long as the management is trustworthy, competent, and high energy, they will figure it out. We need not worry about it as long as we are a patient long-term investor. I think ups and downs are part and parcel of life, let alone a business. So let management worry about all these things.
Right, sir. So one question is on NGL. So he's asking, given CapEx almost getting completed and debt-free balance sheet being leader in animal API business, what went wrong for such deep in margin? I mean, question appears to be incomplete,
No,
but
it's
if you
so
got
N
the gist.
NGL is a good management, no doubt about it. The animal healthcare space in general has been struggling, and they have created a lot of wealth in the previous cycle, and margins are clearly depressed at an operating level. Uh, but when I look at the P&L, I look at the depreciation. So 2019 they were reporting 6 crores of depreciation. Today it's about 12 crores. Let me just see what's the capital work in progress. Have they capitalized the new plant? So there is still. Let me just check. There's still CWIP sitting, and the gross block has. Yeah. So I think again, plant being commissioned doesn't mean that you will start selling tomorrow. So there may be a period of no earnings or low earnings growth. So maybe FY26 may not be a great year for NGL. So you look for any sign of, again, rule one, forward rate of change. So when do you expect the forward rate of change to turn positive? And I think at that point in time, you should try and position yourself in this stock rather than attempting to buy. Again, can you initiate an SIP today? The answer is yes. Do you do you expect returns in the next 1 year? I don't know. But as an SIP, I think, this is a reasonable kind of a valuation where you can start your staggered kind of. Again, the disclaimer, I'm not trying to recommend anything here. But this is how I approach any business which is largely sustainable and there is near-term pain. Again, you need to figure out whether this pain is a permanent or a near-term. Given what NGL has done in the past cycle, I think it's a near-term pain on the P&L. Fundamentally, structurally, nothing has changed in this business. And as this new capex comes online and starts generating cash flows, the earnings delta should again start to look positive. So both in that case, both rule one and rule two will be fulfilled. But I think looking at the margins in last quarter, YOY margins, they were reporting close to 16% operating margins. I think they may not get back to 16% operating margins anytime soon. So maybe another quarter or two of pain left in the system, and a good indicator to check how these the expectations versus the actual outcome is, you see how a company reporting bad results or terrible results, and the stock is not getting punished. That is a positive indicator. That means that the market wasn't expecting any great news anyway. So those kind of, so if the business has reported terrible earnings and the stock is flat or even recovering, that's a positive sign. If the flip side is also correct, if the business is reported a good quarterly set of numbers and the stock is still falling or looking weak, that means that market wisdom, the collective wisdom of the market knows something that you don't. So you got to be careful in that scenario. So again, you wait and watch, and you'll find came next quarter results, and you see how the stock is reacting. If the stock is not following after Q4 results, that means the bottom formation is there pretty much, and then you can start SIP.
So, a couple of questions from the Aarti group companies, some questions on Aarti Industries, and even asking one is asking about management rating of Valiant Organics, and some questions on Aarti Pharma. So, quick
Next,
inputs if you
Aarti,
would like
Aarti
to.
Pharma again. I'm invested. I think the best business in the Aarti group was Aarti Pharma, but that's a demerged business. You can't play Aarti Pharma anymore using Aarti Industries, right? Aarti Industries is a fundamentally weaker business, but the whole commodity space, be it Deepak, be it Aarti, they have been struggling. There is also a new CEO in Aarti Industries. Benzene, I keep calling out that, it's one risk, especially benzene going into pharmaceutical. There's a lot of rejection that is happening in the pharma supply chain when it comes to benzene, because they are replacing a lot of their raw materials with greener enzymatic kind of ingredients. So benzene is a hazardous um, chemical, right? So pharma industry in general, API CDMO space that is, and they've been rejecting benzene. And I've interacted with a lot of key opinion leaders in the sector to say that with a lot of confidence that benzene, this is not the first time I'm saying that. I've tweeted 2 years ago as well on Aarti Industries that, benzene is one area I'm not comfortable with, and Aarti Industries majority cash flows are benzene dependent. So from that perspective, I'm not too sure if I would be very eager to allocate capital into Aarti Industries. I mean, stock may still recover, but I wouldn't be very keen. Aarti Pharma, I think, is got structural sustainable tailwinds. Again, stock has run up in recent times, so I'm not sure whether you should be buying it tomorrow. But in general, I think Aarti Pharma is a better business. Valiant Organics, I don't know. This PAP thing has never enthused me, and there was a lot of promoters selling. Maybe the insider knew something that we were not aware of, and then the promoters started selling about an year or 2 years ago, right? So Valiant Organics, again, I've got no idea. But yeah, within all the Aarti Group companies, the only one that I was always interested in was the Aarti Pharma, and now that is separately listed.
Right, sir. And on the PAP thing, sir, same views which we have shared time and again on Sadhana, nothing changed, right? Because couple of questions on Sadhana
Yeah,
also.
sadhana valuations. I mean, I've no idea. I mean, see, it's difficult to call these commodities out really. And I've been a near permanent bear on Sadhana. I mean, I don't know if I was ever positive on Sadhana Nitro. I know many fund managers and investors have been positive on Sadhana Nitro, but I was, see, my template is very simple. If you are a chemical company, you should be investing behind R&D. You should be investing behind sustainability. You should be investing behind green chemistry. You should be investing behind, adding more novelty and intellectual property to your business. And if you're not doing any of that, so that's why I keep going back to Heikel's example. Look at the R&D that the Heikel has been doing, not just last year, but there's a consistent track record. So those are the companies that will be much more sustainable and well positioned to ride the future over the next 10 years or so. Not company like Sadhana Nitro, I mean, or an Akshar Chem or a Bodal. I mean, yeah, these can be trading funds here and there, for 2, 4, 5, 10%. But wealth, you can't generate a wealth.
Right, sir. And another name which keeps on coming in this, I mean, healthcare pharma space is Bluejet Healthcare Limited. So by any chance you cover
So I
that
expect Bluejet
business?
to report another stellar set of numbers in fourth quarter, but this stock is already pricing all that optimism. So, can you make a large alpha from where this stock is today, or in a short time frame? I'm not too sure. I think there are better opportunities available in pharma space compared to where Bluejet is. Business is good business, sustainable, and I think the earnings will also not disappoint in fourth quarter and maybe FY26. But I think the stock is already run up a lot. Look at the valuation. If I'm not mistaken, it's closer to 15 times price to sales. So that's a rich. Let me just check. That's a rich valuation. I think Bluejet valuations are looking like. Yeah, so 15 times price to sales, and then on EV EBITDA. So EV EBITDA is a good proxy to our EV to cash flow. So yeah, it breached kind of 40x. Yeah, I think it's not cheap. That doesn't mean that the stock will start reversing tomorrow. Maybe as an SIP, if you're willing to play, long-term SIP game in something like Bluejet, and if you want to invest 100 rupees on a monthly basis in a normal scenario, maybe you could invest 20 or 30 rupees in SIP today. But if the stock crashes 50% tomorrow, don't stop SIP. Then you should be having the conviction to double your SIP allocation. So if you are in that kind of a mindset, then I think your probability or chances of losing money over a 5-year period in Bluejet is lower. Again, disclaimer, I mean, it's not a recommendation. It's just giving an example or illustration to help your thought process.
And sir, we have also spoken about amines in last conversation, not yesterday, but I think last quarter. But just to understand, when such kind of businesses fall in the valuation template we use, I mean, to such businesses, what is a comfortable price to sales which we can give, or maybe other metric which are more appropriate for the businesses?
No, so price to sales or EV to cash flow, all these multiples take the terminal value into equation. And and I've been a broken record in criticizing the lack of R&D investments in these amines. A lot of green chemistry, enzymatic chemistry, catalytic chemistry is replacing these traditional chemical companies. So the terminal cash flow is under serious challenge. So, I mean, how can you put a multiple on a cash flow where, you don't know if the business will be sustainable 5 years out, let alone 15 years out, because there is no R&D, there is no innovation happening. So I'll be very careful, and I will never look at how much this stock is corrected from the top to make my buy thesis. I'm more interested in has the terminal value improved year over year, and I don't think in case of MIs the terminal value is improved. So I would avoid.
And sir, we have also spoken about the textile space, and there were some triggers or tailwinds at that point in time, but some questions on the textile segment at this point in time. So broadly, to understand the view on the space as a whole at this point in time.
Yeah, so again, in textiles, I think branded textiles is something that I would be much more interested in because it's kind of lifestyle related. Any textile which is lifestyle related, branded, that is, where, brand has got some perception in a mind space of the consumer. I would be interested in those kind of textiles. So consumption, again, this is another consumption example. So if your discretionary spending power is increasing, if you get a sort of a tax swap or tax cuts which are imminent, right? They start hitting people's paycheck. People will have much more cash in their pockets to do all sorts of um, investments that they have been avoiding probably because um, apparel is something that you can delay, but you cannot delay beyond a point, right? And especially kids' clothing, for example, because kids keep growing up and you need to replace their apparels periodically. So, kids maybe is one area, branded apparels or lifestyle, so marriage related or special ceremony related textile, those kind of themes, as long as the valuations are comforting. Those may be my go-to areas rather than, pure yarn-based company. But even in yarns, I think they are good quality companies. Again, no recommendation, but Ambika Cotton is just one example. Decent balance sheet, decent management. Um, so yeah, as a space, it's not at an inflated valuation. I think it's closer to its long-term mean. So from that perspective, I think textile is a good space to look at.
So one question is on AMI Organics is asking, how do you see AMI Organics terminal cash flow?
No, I think their in some terminal value has increased in case of MA Organics, if I'm completely honest, over the last couple of years because they have invested in the right areas. And they're trying to steer the business more towards the CDMO, the genuine CDMO. And I think that they've been well and truly rewarded. Because if you look at the valuations, I think the valuations, if I'm not mistaken, MA Organics is already above 10x price to sales, which means that market has acknowledged and the value creation in the terminal value, if that answers the question.
Certainly does, sir. I think, sir, pretty well questions are covered because company names will be endless. More or
Mm.
less, majority
Yeah,
of the questions we
it's
have
the
taken. But
process.
anything
No,
more?
it's the process that is more important. And not doing anything stupid, I think, is the mantra. And carry on with this SIP and the formula that I have shared. As long as you are disciplined, patient, a lot of wealth will be created. And corrections are always good, and they challenge our thesis, and they keep us grounded. So from that perspective, an SIP investor investing in a staggered manner, you you so the formula is the same as I shared and I repeated, with some real examples throughout this session. So as long as as an investor has got that discipline and patience to follow along this path, don't get perturbed by the near-term outcome. Your process may be absolutely fine, but the outcome is not showing doesn't mean your process is wrong. And the flip side is, you may be a lucky idiot where you had no process, you bought the stock which was expensive to begin with, and it became even more expensive. So you made the money and you think you have cracked the process or something. No, follow the process. Don't get too influenced by the near-term outcome. And as long as you maintain your discipline and patience, have conviction, read annual reports, read transcripts if you're really serious about your investing, or maybe just go index investing and SIP, in a healthcare index. I think that would be my go-to index. Healthcare, technology, these two pockets are my go-to areas. But there is a higher risk in technology because if a technology is into a sector which is not regulated, it's much easier to disrupt that. So we saw what happened with NVIDIA on the DeepSeek moment, right? Because there is no regulation in that industry. So, a small random event can create a lot of fragility and in the ecosystem. So be careful with technology, but I think the future is all about healthcare and technology. Affordability, accessibility, and technology. These are the themes going into the next 10 years, 20 years. That said, I would like to repeat the disclaimer that, whatever I've mentioned is just a pure illustration. And none of this is any sort of recommendation to trade or an invitation to buy or sell a stock. And but yeah, that's all from my side. Thank you, guys.
Sajal sir, छोटा सा question और है. Rekha ma'am, she is asking, his kid is doing biomedical engineering, and if you can add, I mean, perhaps she is more concerned about how the future is going to be. So in case you
So,
wish to
see,
take
the
that.
basic sciences will never go out of fashion, whether it's artificial intelligence or whatever. And and biomedical is a very interesting space because if you track the global population of close to 8 billion or whatever that number is, the average age is only increasing. So healthcare and predictive diagnostic, these are all good pockets to be in. And as long as someone has got a a serious interest in whatever they are doing, biomedical in this case, as long as they are genuinely interested. I mean, today it's very easy to find information. The world is much more connected. People are much more willing to help. And there is LinkedIn, there is Google, there is all sorts of resources. So I wish this person well. I think sector-wise, it's the right selection that they have made, as long as they stay true to their passion and they invest time and energy in knowledge acquisition. Because there are no shortcuts, whether it's investing or whether it's education. You have to put in the hard work, and if you consistently keep repeating the process of hard work, dedication, keeping your eyes and ears open, having inherent curiosity to